can't keep investing in stocks and bonds and assume that you're going to get to financial independence.
Certainty is the biggest challenge for investors in today's economy.
People often spend more time picking their TV for their living room than they do analyzing, looking at their 401k. And that's kind of a baffling thing to say or think about, but that's the reality of how people invest their capital.
These are extraordinary times for investors. So many of the traditional rules of finance have been thrown out of the window in the last 2 years. From the extreme measures taken by central banks, to the rise of the new generation of retail investor, the distorting impact on the markets of social media sites like Reddit, to the global effects of the pandemic and the different government responses to it. And of course, the rise of crypto and DeFi, which is creating a parallel financial system. All of these factors mean that markets are becoming increasingly unpredictable. And while that can mean opportunity for some, for most, it means enormous risk in terms of planning for a future. That's why so many individual investors are now looking at alternative investments, and why several exciting new ways of generating income have opened up within this space.
I think what's most important for people today is to build themselves a portfolio that's going to generate passive income and growth, and alternatives offer you the chance to build that very portfolio.
In this three-part series, we're going to focus on the latest approaches to alternative investments, highlighting opportunities that simply haven't been available to investors before now. It's going to be quite eye-opening. Individual investors need more opportunities to access higher rates of income. They need to be able to diversify away from investing in traditional stock and bond-only portfolios. Generating income through diversification remains one of the biggest challenges that we all face in making our money work harder for us.
When you think about what most people have access to, stocks, bonds, mutual funds, ETFs, things that are often volatile in times of stress, and a lack of access to private credit and alternative assets that really provide a buffer in terms of volatility, assuming you pick the right positions, right? So keeping risk appropriate for your needs, but getting access away from the traditional 80-20 stock bond allocation really, I think, is important.
Myself, I'm an investor, kids in college, trying to strategize not spending principal and using interest. I'm using the yield from my assets. And as we all think about that today, depending on what news channel you're listening to, the stock market's gonna crash at any moment. What are you gonna do? Taxes are gonna go up double on long-term capital gains, right? There's all of these things that have us in shock.
I think what's most important for people today is to build themselves a portfolio that's going to generate passive income and growth so that when they're prepared to retire, they know that they have the financial stability and the capability to do so. And alternatives offer you the chance to build that very portfolio.
Institutional investors and family offices have been increasing their allocations to alternative investments because of the limitations of traditional assets. For many individual investors, that diversification and the access to high yields simply hasn't been available, which meant that their choice was severely constrained. To access those opportunities, you needed an institutional-sized pool of capital that was clearly beyond most individuals.
So if you think back to when we were younger and we were in college or in school, or our parents, we were always taught that the 60-40 model is the optimal way to invest. It's a combination of debt yields in bonds and investments in the stock market and public equities to give you the growth. The reality is that that model doesn't work anymore. And we need to get really serious about modernizing our portfolios. Why? Because debt yields and bonds are in the ground. They're at or near absolute all-time lows. And the volatility in the stock market is not affording us the opportunity to build a portfolio the way we really want to. And so we need to look for better alternatives.
Interestingly enough, if you're not an institutional investor, you don't really know exactly what an institutional investor's portfolio looks like. But as we've gotten into this very high record after record NASDAQ and the New York Stock Exchange, more and more of the institutional investors have moved from traditional portfolios into alternative investments because they can take non-correlated risks. Institutional investors, family offices, et cetera, are moving more and more percentage of their overall portfolio into alternative investments, whereas retail investors haven't really had access.
Historically, investors have not been able to invest in alternatives, mostly because of structural limitations that have not allowed people to fractionalize large alternative investments.
The alternative investment landscape is now changing. Whereas individual investors were previously sized out of the market, regulatory change and technological development means that they are now able to access these opportunities for diversification and for yield.
So people always ask, why weren't alternative investments available to retail for so long? This is not a new way of investing, but it's new for retail. Two major things have happened in the last 10 years. Number one is regulation has been modernized to allow for what's called 506C. And number two, technology has come so far from where we were 10 years ago that the notion of fractionalizing an investment, so a $100 million investment, that I could now put in $5,000 was simply not possible 10 years ago.
The lack of alternatives to stocks and bonds meant that diversification for many individual investors was extremely limited. But diversification is an essential element of portfolio construction, especially in a world where yields in many markets have been crushed and distorted by policy.
One of the most important questions that each of us need to ask ourselves every day is, does my money work as hard for me as I do for it? We all need to think about modernizing current portfolio theory, right? If the 60-40 model doesn't work, we're living longer. We need to get to a place where we have consistency of passive income, where we have financial independence. We need to be critically thinking, how do we do that, right? And investing in alternatives is really the way to do that, or at least part of that bigger picture of how you get ahead.
The way I think about investing in alternative asset classes or alternative investments really revolves again around portfolio construction, and how would one want to allocate investable capital on their balance sheet, right? Because we all have our own balance sheets, our own liabilities. Liabilities in the form of your mortgage, your obligations, and your assets obviously are your cash, your home, your car, anything like that. And so obviously, every person's investment profile is different based on your income, based on your age, based on your children or responsibilities. The view I take and the way I try to kind of preach to our investors is balanced is key.
Now, if you take a look at smart money, like pension funds and endowments, over recent years, they have invested up to 57% of their total capital in alternatives, while us retail investors are still only at about 6%. They recognize that in order to generate consistent passive income and asset growth, they have to change their portfolio.
So alternatives is, again, one bucket amongst hopefully many that you can allocate a portion of your investable capital to, thinking about, I want some money in this sleeve, I want some money in this sleeve, I want diversification, I want current income, I want capital appreciation, I want duration. I make the analogy that people often spend more time picking their TV for their living room than they do analyzing, looking at their 401k. And that's kind of a baffling thing to say or think about, but that's the reality of how people invest their capital. They don't want to look at it, they don't want to focus on it, because they don't understand it. To enable them to understand these topics and really be educated about it enables them to make more informed decisions and the right decisions. And that's really what not only we're trying to do at Yield Street, but I try to do with friends and family and my own children.
Yield Street is a company that was set up to give individual investors access to opportunities that were out of their reach a decade ago. Yield Street provides them with a huge variety of alternative investments that allows for a greater diversification in a world where traditional investments are failing to deliver.
So for example, at Yield Street, you have an opportunity to invest in things like real estate, single-family rentals, fine art, legal finance, consumer and commercial credit, marine, and more. Then you have some of your more niche assets like real estate bridge loans. You have private equity and venture equity on the other side, so think about investing in the next hot startup or an incredible operating business with a legendary private equity manager.
Perfect example is we recently did some fund-to-fund investments where we invested with other fund managers where the minimum investment there might be 5-10 million institutionally. So we make the larger investment as a group, and then we're able to fractionally allow individual investors to come into that and participate. Really, when you think about the Yield Street platform, you think about it as the kind of highway intersection to all things alternative. So in one point, one place on the Yield Street platform, you can find access to art investments. You can be investing in the reconstruction of downtown real estate in Cleveland or Miami or New York. You can be accessing all kinds of different private structured transactions that you would not have access to anywhere else. And that's what the Yield Street story is about.
Many investors will understand that high yields are the return for taking greater risk. There's some truth in that, but Yield Street helps investors understand that risk is a key part of the decision-making process.
There is risk to alternatives, clearly, and you want to pick the right products and the right credits, but alternatives provides another sleeve, another outlet for capital to invest. Again, I would not argue to put all of your allocation to one or the other, but there is an allocation to alternatives that we think Yield Street provides our investors access to, again, that they otherwise would not find so easily. And we provide that in a really curated, transparent, efficient way. So that's why Yield Street's, I think, important and really worth talking about.
The world of alternative investments can feel like a pretty daunting place. Where should investors begin? As well as curating the opportunities, Yield Street also helps customers thoroughly understand the wide variety of investment products through extensive programs of education and learning, so that individuals are equipped with the information to become better investors.
What we actually focus on at Yield Street is much more than providing investment opportunities to people, but it's also providing a tremendous amount of education and content about investing generally and specifically about alternatives, because we want people to feel empowered to make investment decisions on their own. And so we focus relentlessly on providing a tremendous amount of content and transparency to help people feel comfortable about making that decision.
We have a series of webinars on YouTube and otherwise that our team has put together, educating on real estate, art, and learn about things you might be interested in, and be fully kind of enabled to make decisions that you don't have to be fearful for, I think is the big issue of the day.
Simplicity is also key. Technology has allowed Yield Street to access a huge variety of opportunities by fractionalizing large investments across a large number of individual investors, giving them the same access that was usually only available to an institution. Technology also provides Yield Street's investors with simple tools to access and monitor their portfolios in real time.
Yield Street recognized that if we could build the right technology, the right user experience, a beautiful and engaging platform, something that's digitally native and easy to use, transparent, and something that's built for you, then you would want to continue to invest in alternatives.
Instead of watching every day how things are fluctuating, if you just know you got a check in the mail, and in our particular case, it's a check in your wallet. You have an electronic wallet on the Yield Street site, so that's maybe one of the last things to leave you with, is that when people set up their account, they transfer money in and they have an e-wallet on site. And so they can look at investments, makes it very easy. We have a great application. It's the most diverse platform of its type, and we're constantly innovating.
The range of products available is always evolving to create more opportunities for diversification in response to an ever-changing investment landscape.
That's what Yield Street's done for the last 5 years, is created this, super highway of access, and creates opportunities that people might love art, they love the collateral of real estate, they can participate in senior debt, junior debt, equity.
Now, when we started Yield Street, we were focused on fewer asset classes. For example, litigation finance and real estate. As time went on, we started to see more opportunity that we wanted to bring to our investors. So we added marine finance. In 2019, we recognized that there was this unique opportunity to, for the first time in history, provide retail investors a chance to invest in fine art. Even more recently, during the pandemic, we launched something called Private Business Credit, which was really focused on being part of rebuilding American small business and focusing on commercial and consumer loan products that we knew would be incredibly valuable and necessary to bring America back post the pandemic. What we're constantly thinking about are where investors should be putting some of their cash and generating attractive returns and growth. We most often look to find ourselves and partner with some of the best asset managers and private equity fund managers, private credit fund managers in the country or in the world who can help us deliver quality product to our customers.
In future episodes, we'll be looking at some of these diverse opportunities within the alternative universe, kicking off with products that maximize the returns for short-term cash management, a crucial stepping stone towards longer-term investment goals.